The question that I'd ask you is the same one we've been debating all morning, which is, do we think that it's possible that the Fed was behind the ball the first time in terms of raising rates and now may be behind the ball in terms of continuing to raise those rates in terms of where the economy may be headed?
Yeah, I think there's a lot of reason to believe that. Essentially, they're paying the price right now for the mistakes they made in 2021. If they had been raising rates, much earlier than they did back in 2021, they would have time to kind of stop and adjust at each step along the way and try and calibrate things precisely. Instead, they were behind the curve. They allowed inflation to get as high as it did back in the spring, and so now they're in this race to try and catch up with where they think rates need to be and to try and prevent these kind of inflationary expectations from settling in. And the cost of that is they can't fine tune, they can't kind of calibrate as precisely.
Speak to, though, this issue of credibility, because I think part of the reason the market is sensing this idea that they're going to keep going, and part of it's about credibility more than anything else. If they were to ease up either next month or maybe not next month, but the month after, would that hurt their credibility or help their credibility?
I mean, that's the tough position they're in. I think it would damage their sense that, when they promise we have resolve, we're going to do whatever it takes. You can't give the speech that Jay Powell did in Jackson Hole last month. You can't do the kind of tone of the meeting he did last week and then back off 6 weeks later. The problem is, if you're going to have this kind of commitment mechanism and say we are going to push rates as high as we have to make sure inflation is truly vanquished, then if you turn around 6 weeks later, you're really in a bad spot and you lack credibility for next time. But again, this is the price they're paying for kind of being behind the curve earlier in the year.
But I think the big question still is, are they right or are they wrong about where the economy really is? We keep hearing from CEOs who are telling us actually that there's starting to be some cracks in terms of the labor market. It's starting to get a little bit easier to hire folks. People talk about labor hoarding. Maybe they're going to start to actually release some of those employees into the labor force. That's maybe a polite way of saying laying them off. But if they were to do that, does that change this dynamic and this doom loop that we keep talking about?
It does, but it can't. It's not going to happen that quickly. We've just gotten up to 4% plus. 2-year yields. It takes time for all that to flow through the economy. We're seeing housing crack, but that's a very gradual process. In 6 months, we could be in a clear recession. That's when things really change, and that's when the policy dynamic shifts. But if we're just talking about claims rise a little bit, if we're just talking about kind of CEO confidence and chatter and earnings calls or a little gloomier, that's not the kind of thing that's going to make them reverse course, given the path they've set on and the sense they have within the Fed that, that their credibility is at stake. They really have to do the full Paul Volcker, stand up stiff and move forward no matter what. It's going to take some real movement in the real economic data, not just the kind of forward-looking stuff.
Neil, I would hate for just pure stubbornness to have all of us pay the cost for that. Remember the transitory stance that the Fed took, and they took that for way too long and ignored the data. They were not data dependent on the transitory side of things. Now it's almost on the flip side. They're not going to be data dependent on the tightening side. And it seems like they're informed by everything they've heard about the 70s and Paul Volcker. They've got this idea that suddenly data dependency means stop and start, rekindling inflation. I mean, data dependent used to be a logical, obvious thing that you would want the Fed to consider when it's got so much power to decide how our economy goes. Now data dependency is a bad thing, and it means that you have feet of clay. That's a bad position to be in, and we could get hurt from that.
I mean, you're absolutely right. I think there is a difference between what data we're talking about. Are we talking about, actual payrolls numbers start coming in negative? Are we talking about, the inflation really showing the kind of things that are going to push inflation down over time? Or are we talking about the kind of early warnings? So we had this surge in initial claims over the summer, for example, that's kind of receded. So the job market looked a little rockier back in the spring, summer. Now it looks a little better. I think the distinction is they're going to want to see real evidence that things are taking a shift worse.
What if it's not your father's, all these cliches, but what if it's not your father's job market, Neil? What if it's a hybrid, different this time job market with post-pandemic and low participation rates? And what if that's not the thing that is most important about, what if the rest of the underlying economy is just totally in the crapper and all you've got left is the job market?
Yeah, I mean, there is some reason to think that might happen, right? All these companies that have had labor shortages for the last year and a half, maybe they're going to not respond the way they usually do in a recession. Maybe they're going to hoard workers in a way that they didn't in the past. I think that's a real possibility. And if that's true, then you would expect not to see claims numbers, not to see payroll numbers really drop the way they normally do in a downturn.